Hello there, Jim Hiles, your financial coach at GoPlan and First Capital, and welcome all. Students and professionals want to learn more about investing. This is principle number 2, cash ain't always king. And tonight we're going to be talking about why cash, at least currently in today's environment, this being December of 2019, that we are in a unique scenario. We look back at history that literally, when you look at this thing, we are not making any money at all, really, to speak of in real terms on cash or cash equivalent types of investments, like things like certificates of deposit, even short-term annuities. So if you look at this thing, look at this chart for a second. This goes back a ways, looks like 85. And this is where these are interest rates, for example, that you could have earned on $100,000. Essentially, they looked at all 6-month CDs in these time frames, and you were being able to get, 6.5. You're making all the way back in the 1990. It looks like that's an 8% rate of return anyway on a CD. And all of a sudden, what happened was the rates came down in the early 90s. They kind of came back up through the recovery, and then in 01, this is a fallout, really. A real drastic drop in interest rates, primarily because of the dot-com bubble and the burst. This is the real estate driven burst right here. And really, since that credit crisis that we had in 2008, we've been sort of in this, shall we say, a low interest rate environment for a number of different reasons, trying to stimulate the economy following Fed monetary policy. In a nutshell, you ain't getting anything on your cash because short-term rates are so freaking low and have been low for a long time. They've been really low. So if you're trying to park money in a 6-month CD down in here, you're probably looking in the last 7 to 8 years, averaging about 1.5%. If you're lucky, you can find a 2%, but probably not if you look at a 6-month CD. So we also know there's a lot of money sitting on the sidelines. This 15T is 15 trillion US dollars that's sitting, quote unquote, on the sidelines. And for this being an investment point, is that folks who are sitting on cash are missing out on what could be a continuation of a strong business cycle. It's a long, strong business cycle. It's what they call late cycle, but you can invest here and invest long term, even at this stage in the market cycle. The average rate on a traditional savings account is still well below the rate of inflation. And this is the problem. You park your money in a CD, you got to pay taxes on it. So there goes anywhere from, 10, 20, 30, 40% taxes first. And then inflation is going to be creeping up behind you. Inflation right now is cooking along, depending on what you look at, 2% figure. So if I'm getting 2% on a CD, I'm losing the taxes. I'm down to like 1.5. And inflation is already at 2%. I'm going backwards. So it's really not a great place to store money right now. And we could be in a situation, it depends on who you talk to, where rates could be lower for longer. It could be a long time before we see 5-6% interest rates on CDs. So think about other places to put your money, make it work for you. Cash ain't always king. Talk to you soon. Jim Hiles signing off from GoPlan. Take care. Bye-bye.